So, welcome everyone once again for our weekly review. So, thanks for joining. We had a little bit of a break in spring, and this was a very eventful time. So, just let's start review from where we had left the market when we had our last call. One of the main thing was that we were expecting this April 2nd announcements, which as like say that market was expecting that we will be seeing some kind of negotiation, some kind of deals, and Trump will not take it all the way. So what happened was totally reverse of that. I think all of us were surprised by how far Trump is willing to take it. So what we saw was kind of taking it to the total extreme where he said that all these arbitrary tariffs he started putting. Um, so our take was very simple, and if you are reading some of the updates we have sent in terms of the newsletter or even the weekly updates, my view was that this is a pure, redefinition of how he's trying to define the bipolar world. I think all of us have agreed, and at the start of the call we were discussing earlier that it is becoming more and more of a bipolar world where China's rise is threatening US, and this is what I think this trade war has become. And as we saw over the period of next few days, that's exactly how it played out. We are seeing that there is no relaxation. China is actually taking a more aggressive approach, while everybody else, Trump has decided to reverse them and give them 90 days to negotiate. So this is kind of, I think, becoming deeper, and it's becoming a geopolitical issue for him, and that's where they are taking it. So it's a matter of now who is going to side with China and who is going to side with US. That's the whole game. So now coming to that, I think what is the implication to the market? I think we have to accept that this is not going to be resolved very quickly. So that is the first take which I would have from what played out in last couple of weeks, how Trump has been handling it. Second thing is market definitely doesn't like uncertainty. So we did see the kind of move down, and even I think though he rolled back most of the tariff, which gave market a kind of a jump from all the way from I think around 4,800 levels S&P 500, and maybe we can quickly look at the chart to talk through that. But basic idea here is that what happened since then has been mostly market is trying to pick and choose like which are the winners and which are where are the value. So now it's sorry. So now we are looking at let's go back to asset. So just confirm that you are able to see this window, which is S&P 500 chart. If you're not able to, do let me know. So I think I'm in the wrong chart again today. Yes, I think this is the window now. So I think we are talking about where we were on like how far we fell was actually the same levels which we had formed a top in 2021, and also which we have broken out from early January 2024 when we had so that is the level we have reached now. So that's where the market is. And since then, I think we definitely jumped back another 10%, we can say, and consolidating here. So in that context, I would say market is not as bad, and market is hopeful now since the April 9th reversal of Trump from aggressive tariffs on all the countries. So where we are today is definitely we are now broken down. There is no question about it. There is no going back to the highs without the whole thing is resolved. And now it's becoming more of a how do we take day by day in terms of how these things, if there is any positive news cycle. On the other hand, there is a very good chance technically also because we have bounced back from those very strong support levels, which go all the way back to 2022 and 2024 breakout level. I would say that probably we have seen the worst unless this escalates further. And what do you mean by escalation? I would say, well, if there is something like a actual uh, steps taken by China, for example, because now we have to accept that this is a China-US war. Why I'm calling it a war, there is one more reason. When you talk about 125%, 145% tariffs, those are not tariffs, those are blockades. Those are a message to each other that we are not we are not allowing you to export or import to each other. So these levels, which now they are talking about, is almost, we call it as a wartime blockade. So now that can result into China taking a step saying that, okay, now is the right time to go and take over Taiwan or something like that. That can further create risks. Otherwise, the worst probably is captured. And now we are looking at value picking from, and how the exemptions will play out, how the negotiations will play out. That is what market is hoping, where these things will evolve. So I think we will take questions in a few minutes. So quickly, just to summarize, I would like to say that while this is happening, gold has been going up, which we have been talking about for very some long time. This is a perfect textbook play where there is a lot of uncertainty, a lot of volatility, and people are running towards the safe haven, which is gold. Then we are talking about bonds, which had earlier started dropping. They spiked, which was, I think, the biggest concern. This is what created this reversal. If you see this bond spiking was the first time when Trump panicked, and we saw the. So I think beyond the bond, what I was trying to highlight is that the bond market did uh, recover from the panic, and how Trump really had to come back and take the things back as soon as the bond market started breaking down. Uh, that happened immediately after, this when the tariff were applied, like, in a couple of days. So overall, I would say that right now we are seeing bond market stabilizing, which is where the Besant has talked about, using yield control and many other tools which they are referring to. Um, so other thing I think what we were discussing is the Bitcoin I wanted to discuss, which has basically shown much better response in last few days than tech stocks. It had not panicked in that April 9th, from April second week onwards beyond the same levels which we had already seen. So it did not make a new low. And in recent times, in last few days, we are seeing it actually breaking out from the downtrend trend line. So all these are good signs, I would say, for alternate asset classes like gold and Bitcoin. It has been it's looking fairly good in terms of where the S&P 500 has recovered from the worst case scenario. So that is the summary of the market right now. And we can take a few questions on what people are feeling. But one more thing I wanted to highlight is we did see a lot of stress on the yen carry trade. So while the whole tariff drama was playing out, people need to see that there have been many other factors at play for this kind of recent volatility. And I think what is happening in Japanese bond markets, where the yields are going up, the pressure on Bank of Japan to increase the interest rates is very high. I think that has been very, very huge factor in this whole meltdown of the stock market in US, because as we had seen last year in the August timeframe, July-August timeframe, this is one of the multi-trillion dollar trade it believed to be. And right now, BOJ, just to make sure things don't get worse, they have delayed their rate hike, which has actually saved us from further downtrend on this side. But I think these are still the risk factors which remain. The good news is that now that market knows that yields are going up and there is going to be an interest rate hike, we are hoping that they are already. It's not going to be a margin call. It will not be a meltdown. It will be a slower reversal. So that is how I think we can say that the probably the risk is lesser than what it was, the way it was unraveling last week. So overall, I think my summary would be that we are looking at a much longer trade war, 3 to 6 months of uncertainty, where we may not see any kind of a substantial recovery to the levels seen before. On the other hand, we may have seen the worst. Yes, we bounced back from very strong technical levels, and we are probably going to look at positive. Market is going to look at what other deals being announced. There are a lot of countries like Italy and Japan were already there in this week, and there are a lot more expected next few weeks, where there will be some kind of people who have no choice, like Japan, Korea. Some of these countries have no choice at all but to side with the US and negotiate. and there will be some political wins which Trump will look to get, which can generate some positive interest. The second thing which I think will move the market up would be, which we have been talking for some time, is the tax bill and the tax cuts which Trump has promised. And those will take probably another. Also, it's not a quick thing because it needs to pass, Senate and House committees, and it takes longer time to achieve those results. So with the trade war also continuing with no political pressure for next 15, 16 months till the midterms, I think Trump has taken a long time bet on continuing this trade war. So that's where we are. And the idea would be to play the time value right now, use the volatility to your advantage, and build up for medium to long term. That would be, I think, the short summary of where what we can expect. Um, so I think let us go and take up the questions now. So feel free to put it in the chat or to raise your hand. We can discuss what you guys are thinking about the market and how you are approaching it. While I think mostly what we are trying to target here is nothing fundamentally is going to change with tariffs or with anything. Like if you are talking about AI trades, if you're talking about some of the other innovations. But yes, there can be this going longer will definitely result into some kind of, I would say, uncertainties, lack of spending, maybe some impact in short term on consumer sentiment, which can continue the market to be depressed. Go ahead, please, for the question. So we have a hand here. You can ask the
Yes.
question.
What's your opinion on Trump threatening Powell? Because if he somehow gets into some kind of rage and Powell fires Powell, the all bets are off, don't you think?
There are two things here I would say is one thing is I won't care about Trump's random comments because first of all, means he keeps doing this. Means he makes these statements once in a while. These are typically just to win some political points because he did not like Powell's comments, which he did in the recent uh, kind the I think there was some press release from Powell with some interview of his where he talked about how tariffs are causing inflation, tariffs are creating uncertainty in the business, and a potential growth slowdown. So Powell is not giving a kind of a green signal to Trump. So he just got, mad about it and he made those statements. So first of all, he cannot just fire him because it's not easy legally to fire him. So, and second is even the Besant, his Treasury Secretary, has said that let's not worry about that and let's not take those, these kind of things seriously because he also does not agree that Powell should be fired. The third thing is, I think Besant has already discussed it even before the election that they do plan to install a shadow Fed governor. What I mean by that is they will announce the next governor, next chair, Fed chair, ahead of time in this fall itself. So they can control some of the policy through that, indirect manner using the new Fed chair who can go and give interviews and start defining the policy. Because remember, Fed, while it controls the short-term rates, what Trump and the rest of the cabinet cares about is the long-term rates. And long-term rates are usually always looking at the forward-looking statements. So while Powell has his term till next year, May, I think, um, we might see a lot more control from Trump cabinet within next 5 to 6 months. So I don't think the firing process will be faster anyway because they don't. This is like not in control of Trump. So I don't think that is a huge risk to the market at this moment. And by the way, he also walked back a little bit in this yesterday. I think there was a question from press to Trump whether was he serious, and he said that if I really wanted him to go, he would be gone by now. So basically, he's already walking back on his statement. So I'm not worried about that right now. So I see some more questions in the chat. Do you think any deals with Japan or South Asia, East Asia will be enough to boost markets when they're? So I would say yes, it will be good for the markets for two reasons. One is that right now market is uncertain on whether there will be any deals or any kind of um, like, where there can be anything achieved in short term. So definitely every small positive will be seen as the template for what is coming. Like, it's not about just one country, it's about willingness to come to a terms and willingness to improve the situation. So it's that is what I would see as a positive. And as each of these deals are announced, I'm sure there would be some implication. For example, if certain things are done on are achieved with Japan and Korea, there can be some resolution in automotive markets. There will be some resolution in each of these markets. So, and that automatically starts improving things. So that is how I take it. I would say, let's not, discount the fact that we have these benefits which can come in from each of these deals. I think the biggest, of course, the biggest factor will be China. And I think recently they have talked about, okay, we are ready to negotiate, even though there is no real negotiation happening. But that, I think the biggest issue is still China, I would say. Uh, so let's hope that something positive start coming. But of course, this is not going to get resolved either way, because even if there's a negotiations happening with China, the size of the trade, the conflict level is so high that it's not going to be resolved very fast. There's another question is, what's your comment on Carvana and Hertz? Are tariff increasing price of vehicle can increase the prices? So I would say, Miss, this is very well documented already by, I think, Ekman, his thesis on Hertz. So I have nothing more to add. He's already talked about that. And basically his thesis is that the car prices will go up, the secondhand car prices, which is the inventory of these companies. I think these are more like, at the scale they can play this, but as a retail investor, I don't know if there's enough juice in this kind of plays, because when somebody like Ekman is holding 20%, means he's pumping it up right now using Twitter and so on. You don't want to get, provide him exit liquidity, where you come in very late after he's already accumulated for 6 months. And means I would not see these as, a trades which you can make as a small investor. There's a lot more, opportunity out there as a small investor when you look at the much bigger size of trade. Like when you look at Nvidia's, Apple's, Amazon of the world, they're the small hedge funds, or like, hedge funds like Ekman's cannot really kill you by coming in with a few $1 billion. So you don't want to play in a market where the size of the company is small. So means we can discuss all we want about these stocks, but I think yes, there is some merit to his argument, but where the stock has already gone up and he's already taken a big stake, which he can dump anytime. So you don't want to play those stocks. That would be my view. Um, so then there are other questions at a macro level. Let's take those. Is there any way to trade 10-year treasury? TLT is more of a 20 years. Yeah, I think there is I forgot the name of the ticker, but you can easily search. There are enough 10-year ETFs, just like TLT. Just the liquidity on 20-year is more because people like to play the moves, because the longer the term, as the yields go up and down, you get better returns on. So TLT has become very popular. It's very liquid, but I'm sure the 10-year ETF also is fairly liquid. So I don't have it on top of my head, but you can do that. Uh, I think there's a question about Japan withdrawing from US Treasuries. So I think that is a pretty good question. So let me tell you what really came out. So one of the things which happened was not necessarily Japan selling, and they have already said that they are not looking to use treasuries as a negotiation tool. And I think they cannot even afford it, because they don't want yen to appreciate too fast, because if they do that. I think what had happened is there was a hedge fund which was using a basis trade on US Treasury, which was very highly leveraged. That got liquidated. And that had created this rumor of that there was a huge selling from Japan. And also that also triggered the yen carry trade, which we talked about. So yes, there was definitely Japan-based selling, but that was because one of the hedge fund, and I think now it has been made public also, that hedge fund had kind of lost a lot of money. So that is what happened because of the US Treasury basis trade, where they were playing this arbitrage, and they were heavily leveraged on that. But I think that hopefully is resolved. These kind of things can happen because I think there have been a lot of analysis that how US Treasury trade has become heavily leveraged. And but I think mostly the kind of like US has a safety net because we are talking about Fed, which can print money to anytime support it, and I think Treasury can also do a lot of yield control and other tools. And as we have discussed, I think my view is that we are sitting on a very high interest rate. We are not sitting on 0% anymore. So there are a lot of ways if things go bad, I think they will be able to control that. Like they can do QE, they can do rate cuts. So those are the things which are still yet to be used by Fed and Treasury together. Um, so I think there are a couple of other questions on how do you protect against doubling down on risky bets, how to avoid washing out your portfolio. I would say this is a mostly we call it as a leverage control, right? Means you cannot, if you are investing in quality stocks and if you have ability to hold, if you're not leveraged, this getting washed out is not even a question, right? So if you are buying stocks which will automatically recover as the market recovers because they are high quality stock, they are the growth stocks. Um, so I think I'm assuming the question is more about leverage control. I would say the best way to do that is to just simulate your worst case drawdowns. Let's assume, as I always say, right, means it's a matter of you have to always have enough cash in the account which can cover the allocation of if you are selling puts. You should have some kind of a strategy to test out another 20-30% fall from here. And if you are able to control your leverage, I think scaling up at this point where you know that you can control the worst case scenarios of another 10% fall, I think that would be the best way to do it. Now, it's not a straightforward manner which I can answer other than this, that it because it heavily depends on what kind of stocks you're owning. I think we discussed this in WhatsApp group also in terms of like if you're owning something like a crypto stock which can have much higher volatility, or something like a Tesla which has much higher volatility than let's say Microsoft or Apple, then I think you need to plan for much deeper drawdowns. While we all know that if you look at something like Apple, Microsoft, or Google and all, they probably will be you need to simulate 30 to 40% drawdowns as worst case, which I think will be already we did talk a little bit about the valuations, that most of these companies now are trading at such low valuation historically that they're already becoming value play. So if unless you are totally giving up on the economy, which I think most of these stocks are probably going to not see much bigger than another 10-20% drawdown from here. I think before we will take a couple of quick questions, and probably we can also uh, go back to our topic of the day. Also, that is another thing which is pending. So as China is not backing down in longer term, it might be bipolar world. Do you think US companies' growth in China market will lesser than the pre-liberation day? I think definitely the US brands in China will suffer because we are now talking about kind of a Cold War or a kind of a political rhetoric, which is definitely coming in, which Trump is seeding, right? Means, and it's not that it was not happening already, but it's become very obvious now. So it will be very interesting to see how it evolves, because if you see the brands which were like fashion brands or any of the other stocks which are heavily dependent on China growth, they're already suffering because market is already seeing that this is not a simple trade war like Trump's first term. It is much deeper. So I think all those stocks have already suffered. So now the question is how much of it translates into real long-term trade wars versus whether it becomes permanent. So I would say stay away from any US companies who solely rely on China growth, which have kind of saturated. And if you see most of the fashion brands or brand names, like the whether it's clothing brands, whether it's shoes, whether it is uh, you know and all these like typical growth sectors which China was really providing the boost for these companies, I would say stay away from those stocks, because now that we are entering a world where China may promote boycotting US goods and so on, these brands may find it tough to grow there. So that is definitely correct. But when you talk about Apple and Tesla and so on, I think they are, I mean, at least Apple, I don't think they were already not growing. Like if you see China growth was slowing down even before tariffs. So it has nothing to do with the tariffs in terms of where things were. And Tesla is also facing very significantly higher competition with BYD and so on. But I think Tesla has done pretty well even there because of just the demand and the branding. In terms of also they have very high safety like ratings and so on. So I think you have to analyze by company to company, but definitely there will be some hit on China. Um, so I think we have another comment here on Tesla. So Tesla's earnings on 22nd. How I would say means I would not go into deep on that because that can take we can get into individual stocks, but I would say that Tesla, most of the numbers are already out. So just a quick comment would be if you look at how things are in terms of the delivery numbers and everything is already priced in a lot of negative. So it will be interesting how earnings play out, but I don't think usually there is a lot of surprise in Tesla earnings. Um, I think there's one more question here before we jump into the topic of the day. I see here is that in recent market volatility has been crazy. Have you been able to practice what you preach and generate returns in the market? So I think that's an interesting question. So let me put it this way. Um, so yes, definitely there is a possibility today to generate higher returns than market using options. Volatility, and I've been talking about this for a long time. And I think we also have this managed accounts under our advisory, which we announced, I think, last month. So means we are able to generate positive returns even in this negative market using volatility. That I can say that much. But basically, the idea here is that one should look at this as if you are able to allocate new capital. This is a great time where if you see what happened in even after the week of April 2nd and then when the tariffs were reversed, the amount of money, even while the stocks have not recovered by 100% of their drop, the options decay very fast. And if you are able to do those things, if you're able to use the time premium, you can definitely beat the market. So now to answer the question, yes, means I don't think we have the longer term analysis of that, but just giving you month to date data, we are right now, I think around last I checked was positive 4% green versus negative 5% on S&P 500 when the yesterday market closed. So that's what I can say. And that is purely using the option premiums in our favor. So those kind of things are possible. We can discuss more, I think, if somebody has any question around what is like how to make those strategies. But let me tell you one thing is the sideways market for next 3 to 6 months, this will be a great opportunity to generate high returns if you know how to deploy the option strategies. And not just that, I would say there are two things which one should consider. If you are not even a trader and if you're looking for long-term accumulation or deploying money into the market, think about already we are probably 10% down year to date, and we are this is already a good opportunity. And now if you can accumulate the stocks using options that are even further discount from the market, I would say that is going to give you very high returns in long run, because when you enter at a discounted price, your basis goes down so fast that cumulative return look way better than when you are buying at the market price. One more example I can give is that in our newsletter, we did this QQQ trade. When we entered very quickly when the market dropped initially, we were expecting faster recovery. Our At that point, QQQ was 490. And we right now, after rolling a couple of times, that break-even point has come down to 460. So when you are at, you are able to bring down your break-even point by 8% using options within 3 to 4 weeks. That itself tells you how much of a discount using time premium can give you from the market. So again, this is a topic which we cannot cover in this call. We probably can do a some kind of a discussion on a case-to-case basis in an in-person call or a whiteboarding session. But I would say that there are a lot of ways we have shown that you can use options in your favor to benefit from this volatility. All right, so I think great questions. Let's quickly go into the topic of the day because we are already 4:45. And I will share a couple of data points. So the question was, which was, I think, which we had asked was portfolio allocation, like, in 60/40 versus what is the role of gold, silver, and so. So first of all, just to get started, 60/40 portfolio allocation is very popular, and it is seen as 60% stocks and 40% bonds. And typically, this portfolio has generated pretty decent returns if you see over a period of very long time, where not only in the worst kind of drawdowns, like for example, dot-com burst, we had huge drawdowns on stocks and bonds balanced it out. And as you can see in 70s and 80s, when markets were also volatile, it generated mostly good returns where they provide a dampening factor when the equity is down, because usually the bonds used to do better when equity was going down. In recent times, people have started questioning for two reasons, because as we saw, I think I had an investor event in early 2023, and I remember talking about how 2022 was one of the worst year for bonds, when while the market equity was also down, and it really delivered a lot of negative returns. And similar thing happened in 2008. Why this started happening is because bonds and stocks are becoming a little more correlated because of the whole money printing, and when high inflation world, and when the reason for stock market drop is not fundamental but inflationary, that's when 60/40 starts underperforming the market. um, so I think there have been some questions around it, and but overall 60/40 is a very, very popular uh, narrative, and it's been used by a lot of money allocation people. And the reason being that on a very long term basis, this is a chart of showing how much, how you can beat or stay in positive. Like, they are talking about anything for over a 1 year period, any time frame you started and you allocated 60/40, you had more than 80% chance of um, being in positive after 1 year, and 100% chance of being in positive after 7 to 10 years. And also, it has beaten the cash allocation 100% of time in a longer period of time. So this is what people talk about. But then, what are the other form of portfolio allocations? Let's discuss that, because the question was, but where the gold stands and where Bitcoin stands. So gold is not a new tool, and not a new asset class. So this has been one of the famous, I think, Henry Brown's permanent portfolio, which is 25-25, 25-25, which is basically 25% bonds, 25% stocks. In this, the interesting part is they are talking about 25% cash, which is great for people who need to hold, some cash for emergency purposes, and 25% gold. And the interesting part is that this portfolio has done very well. Means just like 60/40, it has done very well over time, and it has generated 7% average return for a very long period. We're talking about almost 100 year, and it has done reasonably well most of the times. In addition, I think if you compare 60/40 versus this model, it has not, like 60/40 has not beaten it by big margin. And remember, we are talking about 25% cash allocation here in this versus 60/40, where there is no cash allocation, you are fully invested in the market. So this is very interesting data point. And recently, with the gold doing very good, and the cash, when I say cash, remember that this cash is usually put in short-term money market, so you will still earn 4% or 5% in recent times. So if you see here, the even after such a great bull run in equity, the returns have not beaten by big margin when you use 60/40. So the summary is that there is no one good way to allocate. There is definitely a huge benefit of allocating into gold in, historically. And recently, I'm sure, like, if now we have talked about Bitcoin, which has done so much better than every other asset class. And I don't have these kind of charts because Bitcoin is fairly new asset class. But most of the people who allocated into Bitcoin, they have done way better than all of these portfolios. Like, because as soon as you allocate anything like 5% or 10% into Bitcoin, and the kind of thousands of percents of return you've got in recent times, in last few years, all of this portfolio make no sense. But whether it is true or not, that's why we are looking at gold kind of portfolios, because gold, the whole thesis is that Bitcoin will replace as a digital gold. So I think we are looking at gold for a much longer term period here. And as you can see, there is merit to what that is. Now, there is another thesis, which is like, put all your eggs in one basket and then watch that basket. Now, this is probably one of my favorite one, because I have, like, let me give you one example. And when talking about Bitcoin, um, one of my retirement portfolios, I did it personally, where I put 100% allocation into crypto. And of course, I mean, it's volatile, but also we got a tools now. We have got a lot of tools now. Like when you look at now that IBIT is there, now other things are there. And I'm seeing it perform across versus compare it against stock market and anything else. It's been outperforming in last 3 to 5 years, like anything. So again, means I'm not suggesting you should do this or anybody should do this. What I'm trying to highlight is that there are multiple ways you can do portfolio allocation, whether it's 60/40, whether it is 25/25, 25/25, or whether you do everything in one basket. There are ways to make money. It's less about how you allocate. It's about passive versus active investing. Because if you do something like putting all your eggs in one basket, you have to be very, very actively managing it. You cannot just, walk away from it. While 60/40 has been a very popular passive investment model where it has done well over time. It is considered a balanced way to invest, where you get some shock of volatility of US stocks balanced by the bonds. So that is where I think the portfolio allocations go, and we can discuss further on what people think about it. So this was the topic of the day, I think, which was suggested. So those were some of the comments I had. So feel free to ask questions. Would love to get views from people on how they think about allocation. But again, coming back to the whole point about what is the status, what is the meaning of gold or Bitcoin in your portfolio. I think again, we will not never get data of 50 years or 100 years for Bitcoin, but gold is a great proxy to show you how it has done very well in this kind of allocation, where people have been able to allocate and get much better returns with gold, when especially people are questioning right now the 60/40, because in an inflationary, again, my point is very simple, that in an inflationary world, where one of the main reason for markets to fall can be that the inflation is out of control, then bonds and stocks both will be going down, which happened in 2022, which, by the way, it's even this year, we are not seeing bonds doing any better while the equity is going down. So right now, I don't think the whole concept of bonds going up when the equity is down is working. And that may not work in the modern world, in the modern monetary policy. And I think that is why people are talking about moving away from 60/40 and getting into some kind of allocation. One more thing, data point I would say is that recently BlackRock did a paper on how you should do 50/30/20, where they are talking about 20% alternative investments, where the meaning of 20% alternative investment is either real estate, gold, or the Bitcoin, and so on. So there are a lot of interesting studies on this. We can talk about that. But overall, what I can highlight is that it's less about which one is better or which one is worse. It's about using all these new tools. Like, the diversification should not be within equity. Like, a lot of people misunderstand diversification. They end up buying a lot of different stocks, thinking that they're diversifying the portfolio. You don't need to do that. I think diversification across asset classes is very important. So having exposure to gold, having exposure to real estate or a Bitcoin, all these are fairly good way to diversify, rather than as we are seeing, right, means there is more and more correlation which is happening across all the stocks, across um, all the even bonds are getting correlated because of inflationary impact, which is troubling both the sectors. All right, so we can take a couple more questions. I think we are almost at the top of the hour. If anybody else, and we can feel free to unmute yourself. I think we do have that enabled if you want to make a comment as well. So if let me quickly check the chat as well. Okay, so I see a couple of other questions. What's the right metric to measure wealth? Measuring in dollars itself is flawed, as dollars may go down. I think dollar means wealth. When you say, I mean, that's a very good question. But I would still say that dollar is still the world currency. Most of the things are available to be measured in dollar value. So assuming dollar value goes down, you can still measure it in terms of normalized performance. Um, some people have put it in the form of, one way to think about is your wealth divided by average home price, or wealth divided by, a certain commodity you can talk about. Those are other metrics, but those are not standardized. So relative value you can measure when you talk about how to see how much wealth you have is what you can buy using $1 million, and usually I think house is a good proxy. Like average home price in US has been used by a lot of people as a proxy for that. And there are a lot of such proxies, right? When the people talk about a certain basket of goods or something. But still, I would say that being USD being the only currency which is standardized across the world, it's still a fairly good measure for the top line. Whether the value of dollar is depreciating, there's no doubt about it. So some people who are Bitcoin maximalists nowadays talk about, okay, what is the how much Bitcoin you have or how much gold you have. Because again, these are baseline of universal currencies. Like people talk about gold, you can measure your wealth in gold. But I would still say that as a mainstream investor, you don't have to worry about anything, because dollar is still relevant across the world. And it's still the currency which, like, even if you look at GDP of the world, most of the countries measure it in US dollars. They don't measure, it means it almost irrelevant what is their actual GDP in their own currencies. And so I would still consider dollar as a good, fair value to measure, um, while being aware of the fact that your dollar is depreciating in actual value. So that is definitely something to keep in mind, that if you plan for something at a 2% inflation target, and you plan for retirement for a certain $5 million or $10 million, you may need more if the inflation adjusts to much higher level. So that's a fair question, and nobody has the answer for that. Like, what will be the future inflation prices? So one, I think, a better way to look at your wealth creation is on the capital you have deployed, what is your annual return minus inflation? So we can call it the real returns versus the nominal returns. That would be a great metric to track for yourself, because as long as you are generating a inflation adjusted return, that is what would matter. Um, when you're saying it's not only inflation but devaluation, I would say devaluation will be captured in inflation, because when we talk about inflation, we are capturing a goods basket. If you are really getting devalued very fast against other currencies, your inflation will be high. So I don't necessarily agree on this comment that it will not be captured in inflation, because inflation is on a goods basket. And if you see most of the countries where they are devaluing faster, their inflation prices are also very higher. Um, so I think inflation uh, adjusted return is a fairly good metric for you to capture in your metrics of yearly returns of what you're generating on your capital. All right, so we can take one or two last questions before we end.
Can you hear me, Raman?
Yes, go ahead. Go ahead, please.
Just curious, do you track Indian market and do you have any views? And if views, like how to invest in Indian market, any thoughts on that, either through ETF or directly
Sure.
through investments in India?
So I think we can take it up in detail, but there are two things. Yes, we do track. In fact, we do have Proflex India Opportunity Fund for US investors who want to invest in a tax efficient manner directly into India. So that allows mostly US investors to bypass the local taxes and only invest through as a US fund. But basically, let me tell you what is my view on Indian market today. India is one of the only country which is going through a decent amount of growth with very high GDP growth rate, which has managed to reduce fiscal deficit every year in last few years, while even after COVID. And it is going towards a very, very healthy path, where inflation is also come under control in last few years. Um, I would say macro level, India is in a very strong shape. The issue which India was facing is India was not competitive at all in terms of exports. India has been squarely beaten by China, Vietnam, all the other Southeast Asian countries in exports. So India still had a net import country. That uh, probably this is one of the biggest opportunity for India also because of what Trump is doing, and he is picking up basically a fight with China. And there's a really big opportunity here for India to also capture that export market. Definitely not possible in high-tech world. Definitely India is lagging in that. But if you look at textile, pharma already India is leading. Textile, India can claw back a lot of share. And the most important thing for Indian stock market, let's take one step back deeper, not in the macro perspective, but the deep one step deeper. India just started in last 10 years the same kind of middle class stock market investment which was started in US in 1980s. So if you compare US of 1980 when 401ks were started and there was a forced monthly investment which was going into stock market. And by the way, if you see, there's never been any 7 to 8 year period where stocks have gone down in US since 1980s. And the main reason being these kind of monthly inflow into stocks. Say India is just at a starting point of that next 30, 40 year cycle. So stock market in India will anyway do better than even, and also when you look at a high growth GDP country, so that also gives you a tailwind. So that's why I think my view is that India in a longer period, 10-year period, it will be one of the very good performing stock market. While macro, it's kind of balancing out and there are some opportunities here. I would say that India can do very well to moderately well. Definitely not going to do worse than wider markets. That's my take on Indian markets, right?
Thanks, Raman. Yeah.
All right. So I think we are just concluding this hour. Anything else? Let's continue discussion over WhatsApp group. And I think again, thanks for all for joining. This has been very engaging weekly calls. We will try to do it, I think, after this spring break. Now I'm back and will be available going forward next few weeks. So let's keep this going on a regular basis. Thanks once again for joining. Have a great weekend. Bye-bye.